Welcome to another video from Kyprios and Associates Limited. In this segment we will discuss, Introduction to Accounting. Accounting is a language of systematic recording, analysis of financial transactions of a business, and reporting. Accounting identifies, records, and communicates relevant, reliable, and comparable information about an organization's business activities. Accounting is the universal language of business and finance. Accounting helps to communicate financial information about a business to shareholders. Types of accounting are as follows. Financial accounting. It includes reporting of the financial position and performance of a firm through financial statements issued to the external users on a periodic basis. It includes revenues, earnings, assets, and liabilities, together with the profit and loss statement and balance sheet. Management accounting. It combines accounting, finance, and management with cutting-edge techniques needed to drive business successfully. It includes costing, budgeting, net present value and other calculations. Accounting is based on about 5 simple categories. 1. Assets represent value of ownership that can be converted into cash, although cash itself is also considered an asset. Cash, accounts receivable, inventory, notes receivable, prepaid expenses, land, buildings, equipment, furniture, and fixtures. 2. Liabilities, which are obligations that an organization owes to someone else. This includes notes payable, accounts payable, accrued liabilities, long-term liabilities, bonds. 3. Expenses, the cost of doing business necessary to produce revenue. 4. Revenue, this is the income that a company receives from its normal business activities, such as sales or services. 5. Owner's equity. This is the amount remaining after the total value of the liabilities is subtracted from the value of the total assets, known as common stock, retained earnings, revenues, and expenses. Assets. An asset is something that puts money in your pocket, an economic resource. Anything tangible or intangible that is capable of being owned or controlled to produce value, and that is held to have positive economic value is considered an asset. Assets are broken down into 4 basic categories but is not limited to 4. Current assets are either cash, or an asset that can be sold, which is inventories, and supplies that can be turned into cash. Liquid assets is an asset that can be converted into cash quickly, and with minimal impact to the price received, such as cash, receivables, and marketable securities. Fixed assets are assets that are purchased for long-term use, and are not likely to be converted quickly into cash in the near future. These include buildings, equipment, natural resources, and land, which is a fixed asset, but never depreciated. Intangible assets are properties other than the physical assets of a business that helps to create operating profit, such as patents, trademarks, copyrights, and goodwill. Liabilities are obligations payable to pay debts and loans. Current liabilities are debts to be paid with cash, or with goods and services within 1 year or within the company's operating cycle. These include accounts payable and credit card debt. Long-term liabilities are liabilities with a future benefit over 1 year, such as notes payable that mature longer than 1 year. These include mortgages and notes payable. Unearned revenues are payments received before goods are sold, or a service rendered. Bonds, on the other hand, are fixed interest financial assets issued by governments, companies, banks, public utilities, and other large entities. Expenses are the cost of doing business. They decrease owner's equity during the period by using up assets, or a portion thereof. These can also create additional liabilities. Revenue is the income the organization has earned. This increases the owner's equity during the period by performing a service, or selling an asset. Owner's equity is the owner's ownership, or equity, in the business. However, the amount includes the business assets owned by the business and its owners. An individual or company's net worth is used in determining an individual's or company's credit worthiness, and can be used in ascertaining the value of a business, when its owner or shareholders want to sell. This is calculated by taking the value of all assets, and subtracting the value of all liabilities. The equation for this is, owner's equity equals, assets minus liabilities, which is the portion of the assets you can legally claim, or own. The fundamental accounting equation is, assets equals, liabilities plus the owner's equity. When recording transactions into the company's books, every transaction must maintain this equation in balance, for which double-entry bookkeeping is required. The balance sheet. This financial statement shows the net worth of the business. The amounts presented on the balance sheet are aggregated from the entity's beginning to the balance sheet date. It provides a list of the assets, liabilities, and owner's equity in balance. The income statement. This statement is a company's report that indicates how the revenue is transformed into the net income. It further accounts for temporary accounts, also known as subsidiary accounts. This statement also matches expenses against revenues for a specific period of time. The amounts presented on the income statement are aggregated from the beginning of the period to the end of the period only. Income statement accounts are closed out at the end of the reporting period, and started over again in the next period. Hence, they are known as temporary or subsidiary accounts. This statement is further used to determine the net income, or net loss of an individual, or business for a defined period. It is also used for marking progress by comparing months and years. Sarbanes-Oxley. The Sarbanes-Oxley Act, 2002, emphasizes the importance of internal control. Internal control is the procedures and processes used by a company to safeguard its assets, process information accurately, and ensure compliance with laws and regulations. This act is usually heavily enforced with publicly trading corporations who trade on the stock market. It requires companies, and their independent accountants, to report on the effectiveness of the company's internal controls. The major provisions of the Act established the Public Company Accounting Oversight Board. Internal controls are defined as a process, affected by an organization's structure, work and authority flows, people and management information systems, which are designed to help the organization accomplish specific goals and objectives. The policies and procedures protect assets from misuse, ensures that business information is accurate, and ensures that laws and regulations are being followed. Objective of internal controls provides reasonable assurance that assets are safeguarded and used for business purpose, while keeping business information accurate. Elements of internal controls are risk assessment, control procedures, monitoring, information, and communication.